Welcome back to Lamb's Cryptoverse. Today, we're going to talk about a recent video, an article from Glassnode. Glassnode, as you know, and along with CryptoQuant, do great work on-chain analysis. And what they focused on, I'm talking about Glassnode, what Glassnode focused on this week was only really one thing. And this is something I alluded to in my previous video. It was that we have low volatility. And it's not just low realized volatility, meaning day-to-day volatility. It's low implied forward volatility. So what the heck is going on? So let me reduce myself here and let's go to the article I was telling you about. Actually, this is the video. It ties up with the video. They do both, actually. So they entitled this pretty simply. They call this the week on chain, and this is basically week 2. So nothing too fancy. And like I said, the big thing about this week was, well, I could even read it to you right here. The digital asset market has opened a new year by staying asleep. So that's the whole gist of it, that the volatility has been unbelievably low, even lower than the stock market. It's just really unbelievable. So I'm going to read you a few bullets, and then I'm going to get into the good stuff, meaning stock charts and on-chain activity. So the 3 things they mentioned are, as I said already, extremely low volatility. 2, softness in on-chain activity for both Bitcoin and ETH. And I would go as far to say that first of all, yes, it's normal that you get softness around December, right? Around the end of the year, the beginning of the next year. But it's beyond that. It's softness that has to do with apathy. Like people don't care anymore. And of course, the softness related to FTX and how FTX basically screwed all those protocols, those blockchains that were related to FTX, where FTX had direct or indirect investment activity or influence. So this is like Aptos and Near and of course Solana. And the last point they wanted to make out was that drawdowns in the realized cap have been one of the deepest of all bear markets. And if you recall in my other video, I talked about historical drawdowns from the high. And what they did was something else. And we're not going to talk about this too much, because the results are similar to what I showed you already. What they did is they took out all those Satoshi Nakamoto coins, because there's a lot of coins, and they're assuming they're not going to get moved because they haven't been moved. We don't know who this person is. So they took those out to see what the drawdowns are. And anyway, even with doing that, the results are the same. Basically, as I said in my other video, is that we have one of the deepest drawdowns from the all-time highs in history, but we don't have the deepest drawdown. So average large drawdown has been around 80%, and we're about 73 to 75%, depending on where you think the top was. I think the top was in April 2022. Some people say it was November, when technically that was the top at 68,000 versus 64,000. The point being is that the drawdowns are not yet where I think they could be. So like I said, we have a drawdown of 73% plus, and on average they've been 80%. But remember, Bitcoin was born during a period of high liquidity. It's never been tested for the tight liquidity that we have now. Actually, we have the tightest. It's not just that we have tight liquidity. We have some of the tightest liquidity that we've had in the last 50 years, maybe more. So I'm thinking, based on that third point, that we can go lower and maybe test what we had before during the 2011, I think it was 2011 bear market, basically where we had a 91% drawdown. So maybe we go between, like I said, we're at 73, 75% now, maybe between 73% and 83%, 85%, something like that. 91%, that's pulling it. But let's get started, and let me show you the chart that they were showing you here. So here's the Bitcoin week 2 price. And they're showing that the range has only, and you can see that here, my pointer is here, it's in blue. The range, meaning high to low, has only been 3.4%. And people always joke about Bitcoin moving 3.4%, 3 to 4%, or 3 to 5% in one day. And this is over the last week, the range has been really, really small. And then, they mentioned like what happened. So what they said, and this is what I've noticed with other volatility measures, and they said and I said that when you have periods of low volatility, they lead to, yep, you named it. You probably guessed it. Periods of very high volatility where it just spurts up. And that volatility is usually associated with an increase in market price, whether it's stock prices or Bitcoin price. However, and here in these bullets, they're given each example of basically empirical evidence of what happened. But, and I was about to say earlier, November 2018, that period of low volatility immediately preceded a 50% drawdown in 1 month. That is unbelievable. So it looked like we have really good data, like we had data supporting higher prices, because if you look here at the first bullet, it says early bull market 2012, 2013, where Bitcoins were between $5 and $14. Basically, and then late bear market 2015, and then it set the stage for the bull run. Basically, with that, I'm not going to read them all to you. What they're saying is most of the time, low volatility has been a good thing, but I haven't seen that with stocks. I actually have seen the opposite. When you get periods of low volatility, the stock market volatility goes up, and it goes up because the stocks are declining. So I think that's what we could get. And here, before I do that, I want to talk about this. This is from the block. I always like, and I always say, I like to confirm what I'm seeing from different data sources. Remember, Ronald Reagan, before we were born, some of us were born, he said, trust, but verify. And here's an example. If you look at options activity, I want to verify that there's been apathy and there's been low volatility. So here you're looking at open interest in Bitcoin options. You can see it's gone down dramatically. And you can do that same thing with futures. If you click here on the left, but we're going to do that. I'm not going to do that today in the interest of time. I just want to focus on volatility. And here you can see Bitcoin volatility has gone down to the lowest on this chart. And so has Ethereum volatility. And you can see the same thing on and on with the index variance. You can see that the put-to-call ratio has been down. So that's a negative in terms of contrarian indicators. That ETM implied volatility is lowest again on this chart. What else? I want to focus on the put-to-call. Let me see if I can get that here. And you can see the put-to-call is hovering at very low levels, especially for Ethereum. So to me, that means, since it's a contrarian indicator and there aren't too many investors buying puts, that's telling me that the market is going to move down for both Bitcoin and Ethereum. So let's go back to that chart I want to show you. And that's this here. Let me just move myself down a little. Actually, I'm going to move myself up here. And you could see in the periods of blue, where the blue bars are, those are periods associated with very low volatility like we have now. And you could see that the market usually jumps higher after those periods of low volatility. Just to repeat, the orange line is realized volatility over the last month, and the green horizontal line going across here is what today's volatility is, and it's cutting across to what it compares to in history. And so you can see we're at pretty much the lowest levels in history. So let's get back to the charts here. And of course, this is the Bitcoin price in black. And now you can see, again, as I mentioned earlier, we got a blue vertical line indicating low volatility. And what happens? Bitcoin goes up. Again, in late 2015, periods of low volatility, Bitcoin prices go up. Same thing for 2016. Same thing for especially 2016. And one thing I like too is if you think this is a bullish thing when you have low volatility, you want to see it for a long period of time. And if you look here, we had a long period of low volatility in the year of 2016, but we don't have that now. So maybe that's what we need to look for. And then the highlight in 2018, because I mentioned to you earlier, that was a period where we had low volatility and boom, we went down 50%. So that wasn't good. So maybe we should focus, if we want to be bullish, if we want to force ourselves and read this in a bullish manner and wear those rose-colored glasses, maybe we should focus on those blue vertical bars that are for longer periods of time. And we don't have that yet. The next one here is basically this is for Ethereum, and it's saying the same story. I don't want to repeat it, but it's showing the same trends. Like in November 2018, it showed a period of low volatility, and then boom, Ethereum crashed. But in July 20, there was a long period of low volatility, and then Ethereum skyrocketed. And now, again, we're at that low realized volatility. One other thing which I did not mention here is that altcoins are starting to do well. So that's telling me that we're getting a little speculative, which always brings out the risk manager in me and makes me pull back on risk. You don't want to see altcoins going parabolic like Avalanche and even Solana and Cardano, because it's showing you that the market's getting a little bit speculative. Of course, there's some news about, as you know, the Shanghai upgrade in Ethereum is going to allow for some unlocking, not immediate unlocking, but it will allow for unlocking of all those Ethereums that were locked up basically in the beacon chain, right, before the merge. So as those coins unlock, I believe, and I'm guessing, those monies are going to go to more speculative coins. So maybe that's why all coins are doing better now. I don't know. Now I'd like to talk to you about the stock market. Here we have a VIX of 21. If you look back over the last year, that's basically around the lowest points we've had in the last year. And if you recall, I said I don't like when we have low volatility. And this is forward volatility, and implied volatility as calculated by the Black-Scholes-Merton options pricing model. Say that 3 times fast. But basically, to me, this low VIX is saying that, hey, stocks are doing well, and I said they could do well in one of my videos where I talked about how we can get that Santa Claus rally in January effect, but I said it would be a short-term thing. And I'm sticking to that. I think market could go up short term, but I'm really worried about this low VIX because I think this period of low volatility is going to be followed by a period of higher volatility, a higher VIX, and then rapidly declining crypto and stock prices. I think we're almost done. This is the last. Yeah, that's it. And so I wanted to say thank you. Thank you all for listening. And if you are not sure about some of those other concepts that I talked about, please go back to the videos and check them out. And if you have any questions or you have any requests, you'd like me to work on a specific blockchain project or look into something, please let me know. And lastly, don't forget to like us and subscribe to us. Thank you.